There was a huge plunge on Wall Street on Monday, caused by nervousness. Stocks in Japan, Australia, South Korea and China all fell, and tracking losses in the US.
You could say there's nowhere to hide on Wall Street. Stocks from apparel to airlines and even the big tech darlings took a dive during Monday's trading.
So breaking just a short time ago on social media, President Trump signaled a major concession in his tariff policy toward China.
President Trump's trade policies sparked off a sell-off.
All of this points to the fact that the uncertainty is only mounting. We're seeing the fear spread into other parts of the economy as businesses and families are figuring out what this means for them, not just in terms of high prices, but in terms of slower growth and possible layoffs.
Sound familiar? These headlines are everywhere right now. Markets are down, volatility is back, and for a lot of people, that creates panic. But here's the thing, volatility isn't new, and it's not always a bad thing. Hi, I'm Greg Shaw, and welcome back to Wealthstone. Today, we're going to talk about market volatility, why it's normal, what it means for your investments, and most importantly, why staying invested can be one of the smartest financial decisions you will ever make. Yes, the last few weeks have been a rough ride. Since April 1st, we've seen the Nasdaq drop around 4.79%, the S&P 500 slide roughly 5.39%, and the TSX is down about negative 6.07%. Add in inflation concerns, interest rate uncertainty, and talk of new tariffs, and the media has everything it needs to stir up fear. But let's step back and ask a question. Is this really a crisis or just part of a normal market cycle? Because volatility isn't a malfunction, it's a feature of how the markets work. Markets don't go up in a straight line. Historically, we see 3 to 5% drops several times a year. 10% corrections, also fairly common. Even 20% bear markets happen every few years. And guess what? The market has always recovered. In fact, over the last 70 years, despite wars, recession, inflation spikes, and pandemics, markets have continued to trend upwards over the long term. Short-term pain, long-term gain. But that only works if you stay invested. So let's dig into some powerful research. This comes from Fidelity Investments. They looked at what happens when investors try to time the markets, and it's eye-opening. If you had invested $10,000 in the S&P 500 back in 1980 and just left it alone until the end of 2022, you would have ended up with over $1 million. But what if you missed just the 10 best days in that entire period? Your investment returns would have dropped to $483,000. Missed the best 30 days? You're down to 173. That's an 80% difference just by being out of the market for the best days. And here's the kicker. Those best days often happen right after the worst ones. So if you bailed after a big drop, you likely missed the rebound. Anybody see the markets on April the 9th? This is why we always say, time in the market beats timing the markets. And if you're investing for retirement, a down payment, or long-term growth, your success isn't determined by what happens this week or next. It's about being in the market consistently over time. Volatility can even work in your favor, especially if you're contributing regularly. That's what dollar cost averaging is all about, buying more shares when prices are low, fewer when they're high, and smoothing out the ride over time. So yes, volatility is uncomfortable, but it's also an opportunity. You just have to keep your focus on the bigger picture. So, what should you be doing during a market pullback? Number 1, stick to your plan. If your investment strategy was right for you a month ago, a dip shouldn't change that. Number 2, stay diversified. Balanced portfolio helps absorb shocks and reduce overall risk. Number 3, use your cash wisely. If you've been sitting on the sidelines, volatility could be your window to buy quality investments at a discount. And number 4, talk to your advisor. Talk to me. That's what we're here for, to help you make decisions based on goals, not emotions. The truth is, volatility will always be a part of investing. But how you respond to it, that's what defines your success. Don't let fear steal your future. Stay patient, stay focused, and most of all, stay invested. If you found this helpful, give this video a like, subscribe to the channel, and share it with someone who might be stressing about the markets right now. As always, if you want to talk about your strategy, I'm here to help. Thanks for watching. We'll see you in the next one.